Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. Okay, so when we're thinking about impairment testing, the first three scenarios are going to be the most similar. And what's important to note is that these calculations will all be the exact same unless we are talking about an intangible asset with an indefinite life. In other words, the calculation for impairment loss will be the same for property, plant, and equipment, as well as intangible assets with a finite life. All right, but we're going to start by talking about testing for impairment for PP&E. Okay, so this property, plant, and equipment will be subject to an impairment test on an annual basis and must be tested for what's referred to as recoverability. Okay, so the exam wants us to know income statement related impacts as well as a balance sheet related impact. Okay, so thinking back on Moreno's pale ale distribution, we're testing for impairment on this fixed asset. All right, so step one is going to be to determine if the impairment loss even exists. Okay, so let's be very clear. This is not calculating the impairment loss itself. This is just determining whether or not we need to calculate the impairment loss, right? Does it even exist? So in order to calculate step one, we need to determine the asset's recoverable cost. So what does that mean? That sounds sort of unfamiliar. Well, let me tell you, an asset's recoverable cost will be the total undiscounted future cash flows that can be generated from the asset. And that's going to be compared to the net carrying value of the asset. Okay, so if at the end of the day, the book value exceeds the total amount of cash that we at Moreno's Pale Ale Distribution think that we're going to collect from this asset, then an impairment loss will exist. Okay, so because of this new regulation, we can't max out this fixed asset, right? It's not going to make us as much cash as we once thought, right? So in essence, undiscounted cash flows is very similar to the proceeds from the sale of a fixed asset when calculating a loss in that normal sale. So let's say that because of this new regulation in the beer distribution industry, Moreno's now thinks that each of these machines with a book value of $50,000 will only generate $30,000 of future cash flows. So what we're saying is that for each of these $50,000 machines, they will only generate $30,000 in cash, and that's no good. Okay, and the reason is because of that new regulation. It says that they can only distribute the beer in state. So if they were allowed to go out of state, as they originally planned prior to this new regulation, then the cash flows might have exceeded the book value. Right, but essentially we're saying that something bad happened, and now we have determined that this impairment loss exists. So that's step one. In step two, we're always going to be calculating the actual impairment cost. So this is the amount that is getting recorded when calculating the impairment loss, right? So we're simply going to take the fair value of the asset and we're going to compare it to its net carrying value. In some cases, you might see that the fair value is referred to as the present value of the future cash flows. Right? Ultimately, if no comparable market price exists, then the present value of the cash flows would be used to measure fair value. In other words, what is the current value of this future sum of money worth today? Okay, little detail, but general rule of thumb is we're going to be comparing the fair value to the book value to calculate our impairment loss. Okay, so another sneak attack they might throw your way in an exam question is if this fixed asset was held for sale. In other words, we're planning on disposing of this asset. So if the asset is held for sale, you need to be on the lookout for disposal costs. Okay, so we're going to slip that into the calculation and add it back to this loss, which is ultimately increasing the loss on the income statement. All right, so that's how the impairment loss calculation is done. Okay, so just some small differences if the asset is held for use versus held for sale. So step one and step two are now complete. we now know from step 1, yes, an impairment loss exists. In step 2, we went ahead and actually calculated the impairment loss that is getting recorded by comparing the fair value to the net carrying value. Perfect. But that loss only tells us what is impacting the income statement, but we still have this fixed asset that is sitting on the balance sheet. So we need to ask ourselves, will there be any impact to what is getting reported in the balance sheet? And the answer is yes. So basically, we now have this long-lived asset with a fair value that is less than the carrying value. So we're going to be reporting the long-lived asset at the lower fair value. So this becomes the amount that we're now depreciating this asset by. Okay, but what if the asset goes back up in value, right? So the fair value is going back up after we've written it down, right? Let's say that the beer distribution regulation has a change of heart and Moreno's can now start distributing across state lines. Well, the fair value is what went up, but can we bring the asset's value back up with it, right? And when I say that, I mean for financial statement reporting purposes. And the answer is generally no, unless the asset is being held for sale. Okay, so let's say that on day 1, Moreno's impaired assets carrying value was $50,000 and the impaired assets fair value was $35,000. So we already have a $15,000 impairment loss to the income statement. But what about the balance sheet? So we're going to mark this down to the lower fair value when we are reporting this asset now on the balance sheet. Okay, so the new carrying value on the balance sheet becomes the $35,000 fair value amount. But what about this concept of restoration, right? Let's say the very next day the asset goes back up in value. We've already written it down, but it increased to $40,000. It's now being recorded at $35,000. And what we must remember is that the asset's carrying value will not be restored, aka will not increase to the new fair value amount and will stay at $35,000. Okay, and the exception to this rule is if the asset is held for sale. If the asset was held for sale in this case, then we would report it at the $40,000. Okay, so taking a look at our first impairment example, we see here that during year 1, Moreno's Pale Ale Distribution Co. is testing for impairment on the only fixed assets in the company balance sheet. Due to unforeseen regulations on the company's ability to use its fixed asset at full capacity, it will only generate $5,000 per year for the next 5 years. So the company's asset has a carrying value of $22,000 and a fair value of $26,500. So we're going to determine the impairment loss on Moreno's fixed asset for year 1. So we're testing this fixed asset for impairment. So we have our 2-step process, right? Our step 1 is just determining whether or not the impairment loss even exists. And we're going to do this by comparing the carrying value to the undiscounted future cash flows. So comparing the carrying value of $22,000 to $25,000, right? Where are we getting $25,000? Well, we say that the asset will generate $5,000 per year over the next 5 years. Okay, so this is how much money we expect to make from this asset. All right, so the asset will not be impaired in this situation. And the reason is because we can expect to generate more cash flow than the asset's carrying value. Right, we're still making cash from this asset. Okay, so taking a look at the second example, same situation, only now we're saying that the carrying value is $30,000. So we're still going to be comparing the carrying value to the undiscounted future cash flows. The undiscounted future cash flow is still going to be $25,000. This is the amount of cash we expect to generate from this fixed asset. But the amount of cash that we expect to generate is less than the carrying value of the asset. So that tells us that an impairment loss exists. So now moving on into step 2, we're now determining the actual amount of the impairment loss. Right? This is the amount that is getting recorded in the financial statements. So we need to consider now whether or not the asset was held for use or held for sale. So nothing tells us that the asset is held for sale. And the general rule is unless that it explicitly says that the asset is held for sale, or unless it provides some additional information such as the cost to sell the asset or the cost of disposal, we're going to go ahead and assume that this is held for use, right? We're still using the asset. So all we need to do now is compare the asset's carrying value to its fair value. The asset's carrying value we know is $30,000, And we see here that the fixed asset's fair value is $26,500. So we're going to record an impairment loss of $3,500. All right, so let's go ahead and assume same situation. Only now we see here that there's additional information that indicates that the asset is held for sale. So the asset is held for sale and has a $500 cost to sell. Okay, so nothing's changing in step one. We're still determining that the impairment loss exists by comparing the $25,000 to the $30,000. But now in step two, we're taking the additional step when calculating the impairment loss. So the impairment loss is still being calculated by comparing the fair value to the carrying value, right? $26,500 to $30,000 gives us a $3,500 loss. But now we're just going to go ahead and add that additional $500 to increase the loss. Okay, so the total loss is going to be $4,000.